Hello and welcome to the Suzanne and Sarah YouTube channel. I'm Suzanne Moore, a realtor here in beautiful Sunny Bend, Oregon with Realty One Group Discovery and the founder of the Central Oregon Investor Network, which brings together investors not only from Central Oregon, but from all over the country to share resources, learn from one another, and help each other create more passive income in our lives through real estate investments. In today's video, we are going to talk about home buying options for the self-employed so that you can navigate the path to ownership, whether you're self-employed or working for somebody else. Hello everyone, welcome to the Suzanne and Sarah YouTube channel. I'm Suzanne Moore.
And I'm Sarah Willis. We are Central Oregon's investment and real estate experts.
As a realtor myself, I know that being self-employed can come with a lot of great perks, but there are some challenges, and one of those challenges can be securing a mortgage for a home. Traditional lenders often require a stable income and traditional employment history, which can make the process a bit more complex for folks like us who are self-employed. But don't be discouraged. Ownership is still totally within reach, and in today's video we're going to talk about several different options and strategies for self-employed folks to realize your dreams of owning or investing in a home. So the first route, of course, is getting a traditional mortgage. So traditional mortgages generally have stricter requirements for self-employed individuals, generally requiring 2 years proof of self-employment income. So it's still a viable option if you can prove that you have consistent income over the past 2 years. And here are a couple things that you can do to improve your chances of qualifying for a traditional mortgage if you're self-employed. First one, of course, is keeping your credit score strong. So just maintaining your healthy credit score to demonstrate your financial responsibility. The second one is, of course, tax returns. So making sure you've got clear and accurate tax records for the past 2 to 3 years, because lenders often look at those to analyze your income, and they'll be looking at various tax documents. The third one, of course, is stable self-employment income. So if you can show that you have made pretty consistent amount of money over the last 2 to 3 years, that will help, even if it fluctuates a little bit. And finally, a large down payment. When you've got more skin in the game, traditional mortgage lenders are more likely to work with you because that can help offset their perception of risk at you taking out a mortgage with them. The second option is what's called bank statement loans. And essentially, bank statement loans are designed specifically for self-employed individuals because these bankers know that we can't always demonstrate traditional income documentation. So instead of tax returns, you would provide your bank statements to demonstrate your income. And you can expect higher interest rates and some stricter requirements when you're doing a bank statement loan, but it's certainly a great option for those of us who are self-employed. So great thing to think about there. The third one is somewhat more complex, and it's called a DSCR loan. DSCR, that stands for Debt Service Coverage Ratio. And you can think of DSCR as essentially like a financial checkup for the investment property that you're purchasing. And essentially, it's a number that shows how easily the rental income can cover the loan payments, including interest and principal. So the higher the DSCR ratio, the better, because it means the property has a strong ability to pay its own bills. So instead of you personally having to qualify for the loan, it's more like the property is qualifying for the loan with the income it's bringing in from rents. So an important part of the DSCR calculation is net operating income, or NOI. And essentially, this is the money left over after you subtract all of the property's expenses like repairs, taxes, insurance, from the rental income. It's like the property's profit before you pay the loan. So if you want to calculate DSCR on your own to see if the property would even qualify for a DSCR loan, here's how you do it. You will divide the NOI, the net operating income, by the total loan payment. So if the net operating income is $1,000 a month and the loan payment is $500, the DSCR would be 2, which is great. I think most DSCR lenders would be thrilled to see a 2. And that means essentially that the property's income can cover the loan payment twice over, which is considered very good. So let's talk about the benefits of a DSCR loan. It's a great way to qualify for a loan without relying on your self-employment income. So it's perfect for investors who show low or no income on their taxes, or those who just prefer to keep their personal finances separate from their investments. It also really helps you as an investor to focus on the property's potential because you're calculating, how much the rents can cover the mortgage and then some. So essentially the loan is based on the property's ability to pay for itself and generate income, not just your ability to generate income. And it can unlock some great investment opportunities for you. It opens doors to properties that might not be accessible to you with traditional mortgages. Things to keep in mind about DSCR loans is that the requirements can vary by lender. So it's really helpful to talk to a number of different lenders. And here at the Suzanne and Sarah YouTube channel, Sarah has recently purchased a property using a DSCR loan. So she is a fabulous resource. We've also got a number of different DSCR lenders that we can connect you with. So these lenders are generally looking for a DSCR or debt service coverage ratio of 1.25 or higher. This can really vary depending on the lender and the property. So again, come to us if you're looking for recommendations or even just want to talk more about how this works. You will probably pay a slightly higher interest rate for a DSCR loan. It depends. Sometimes they're higher rates, sometimes they're lower rates than other investor loans. But compared to traditional mortgages where you're an owner-occupant, the DSCR loans will probably have higher interest rates due to the perceived added risk for the lender. And DSCR loans are not for everybody. They're best suited for experienced investors who really understand the risks and can manage properties effectively. So we'll do a totally separate video on DSCR loans, but that's kind of the gist of that for now. Okay, going back more to the traditional route, there's FHA loans that could be an option for you. So that's Federal Housing Administration, and they're government-backed mortgages that offer more lenient requirements for credit scores and down payments for qualifying first-time home buyers. And even if you've owned a home before, you may still qualify for FHA. So don't think that if you've been a homeowner at any point in your life, you don't qualify, because you might. So self-employed individuals can potentially qualify for FHA if they meet income and credit criteria. Another great option for those of you who are veterans is, or if you're active duty, is a VA loan, so a Veterans Affairs loan. They often have way more relaxed requirements and may not require as much documentation of income and stability. And one other thing too about VA loans is oftentimes they are assumable. So let's say you're looking at a property and you're a veteran and it's got an assumable loan, you may be able to assume that loan for the outstanding mortgage amount that seller has, potentially at rates from 2021, 2022, and earlier when they were down in the 3s and 4%. For those investors who have multiple properties, a portfolio loan could be a really good option, especially if you're self-employed. So these are generally in-house loans from local banks or credit unions, and they keep them in-house rather than selling them off to investors, which is what happens with most mortgages. So they're in-house loans, and they allow for much more flexible lending criteria and a more personalized approach to your situation. So let's just talk about how to improve your financial profile regardless of which loan type you're going to go for. And this is important no matter what for any type of buyer. And really, to increase your chances of getting approved for a mortgage, you are always better off by paying down your debt. And sometimes you'll have a great mortgage broker that looks at your whole situation. Maybe they see you have a car payment and a student loan payment and a credit card payment, and they might have you actually pay down one or more of those before you apply for your loan to reduce your debt to income ratio. So that's a really important thing to make you a more attractive borrower. You can always increase your income by getting a side hustle, taking on projects, clients, or diversifying your income streams. And documenting your income is also important. So just maintaining organized and accurate records of your income, your business expenses, and of course your tax returns. And another option is just having a co-signer on a joint application or doing a joint application. So essentially having a co-signer with either steady income, maybe they have a pension or retirement, Social Security, maybe that's a parent or perhaps a spouse who has more stable income and employment history. Additionally, you can save for a larger down payment. We already covered this. Definitely helps to have more skin in the game and mitigate the perceived risk by lenders. And finally, I would just say to consult a mortgage broker because they have access to such a huge range of different mortgage products that you may have never even known existed, and they change all the time. So they can match you up with the right lender that is more likely to approve your application based on your own specific circumstances. So just wrapping up today, securing a mortgage when you're self-employed can require a bit more effort and creativity, but it's totally possible. And really, you just have to be proactive in your financial documentation, improving your credit score, and exploring those different loan options that I just told you, like change all the time. And lenders are getting approved for different programs that can be more beneficial to you all the time. So don't hesitate to seek guidance from professionals like us. If you want some background on DSCR loans and experience, Sarah is a great resource. And we are here to be your resource for all things real estate investment related. So thank you so much for joining our video today. Please like and subscribe, and we will see you on the next one.